Coming up in today's show, stocks finish mixed on more weak economic data, why the bulls are calling for new highs soon, oil prices plunge, along with the shares of Walmart, Intel stock rips higher, and Michael Dell mocks Carl Icahn. Hey, what's up everybody? Welcome back to the Click Capital Daily Market Show. Thanks for tuning in today. I'm your host Jared, and I'm going to get you all up to speed on the latest developments going on in financial markets. And it was a bit of a mixed day out there, led by mega cap tech as the winning group again, with energy and oil and gas being the losing group on the back of crude falling. I'll get into that on the charts a bit later on. We also saw some big falls on Tesla, down 3.8%, Cisco down almost 10%, and a huge drop for Walmart, down 8%, along with a nice pop in Intel, up almost 7%, all of which I'll dive into on the charts later on as well, along with my analysis on the S&P 500. And like I thought yesterday, we would stall out around this level, 4,500, a bit of a resistance zone here. And it was actually small caps as the weakest group today. The Russell 2000 down 1.6%. So it looks like the market may have stalled out a bit here, but stick with me because I'll dive into that and my other custom indicators a bit later on. First, let's go through today's news. So what's been getting the stock market excited lately is weaker than expected economic data, supporting the view that the Fed is done hiking rates, and we just got a bit more of that today, with US industrial production output dropping 0.6% in October, a bit more than what was expected, likely helped by the United Auto Workers strike against the big three car producers that lasted about 6 weeks. And even so, economists were predicting a 0.4% decline. And so industrial production is contracting. And that's been the trend in manufacturing for a while now, and even more so around the world. We also saw weekly jobless claims come in a little higher than expected, pointing to a little bit more of a softening in the labour market. And that came in at 231,000 new people claiming jobless benefits, and it was a little bit higher than what economists had forecast at 220,000. And so based on that data, bond yields pulled back again between 7 and 10 basis points across the curve. And now got the 10-year at 4.44, and Fed Fund futures still saying pretty much that the Fed is done, almost 100%, even almost given a 1 in 3 chance they may cut come March, and a 57% chance that they will have cut come May. And so that's got the bulls excited that new highs are just around the corner on the back of the Fed being done, and interest rates, at least in the short term, shouldn't go any higher. And even though we've had a huge 400-point rally in the S&P 500 over the last 3 weeks, and some technical signs it's starting to stall out, some analysts are saying don't sell equities just yet, with some analysts saying we're in the process of the rest of the market catching up to those mega cap 7. We're starting to see some improved breadth. And it's true, because option dealers who have a really strong track record of pricing the market are still showing negative volatility risk premium. And that basically means the VIX at 14.3 is lower than realized volatility at 16.4. So the stock market's currently moving at an annualized rate of 16.4 percentage points, whereas the average implied volatility on near-dated at-the-money S&P 500 options is around 14%. So option dealers are not worried at all, and this stock market is very calm for now. And once again, that's in big contrast to the bond market, as bond market volatility is near record highs relative to stock market volatility. Just looking at the move versus VIX spread here at 8.10, and just zooming out. And the last time we were that high for a period of time was back here in early 2008, just before the GFC. Then come the end of Q1 2009, that spread had fallen significantly at the same time the stock market bottomed out. Just as we did after COVID low, the spread bottomed out really low. And so the bond market thinks there's going to be a recession next year. Bond yields are moving around quite a lot, and you could think of interest rates as the foundation for all financial markets. And so the foundation is pretty loose and moving around a lot. It's not out of this world to think that stocks may catch up to that. However, for now, the stock market is not forecasting a recession. They're saying earnings are going to get back to 10% growth next year, which is something that doesn't happen during a recession. Typically, corporate earnings contract in a recession. And so again, we'll just have to see who's going to be right, stock market or the bond market, come June next year. And so the trade this year has been mega cap tech, the $1 trillion club, the Magnificent Seven, all had a really great year. It's a really concentrated trade. A lot of people think it's going to spill over until next year, and that they should continue leading the market and help pull up the rest of the market. However, according to analysts at Goldman Sachs, there's no reliable correlation between trailing and forward outperformance when it comes to the 7 most valuable stocks in the S&P, and that the 30 percentage points of outperformance of the 7 largest stocks at the start of this year versus the rest of the index year to date ranks as the second largest annual difference since 1970. And we can see in these two charts here that the weight of the top 10 stocks in the S&P 500, encompassing the Magnificent Seven, is currently at 32.4%. That's the heaviest weighting of the top 10 stocks we've ever seen in the index. And you might be thinking, well, that's justified, Jared, because their earnings have grown to records as well. However, that's not true, because the contribution of the top 10 earnings to the S&P 500 as a whole is sitting around average. That's 20.5%. And that's the Magnificent Seven trade, that concentrated trade. Everyone buying shares of Apple, Amazon, NVDA, and a lot of people thinking that spread can keep going further and further. And just looking at a composite weekly chart of the mega cap 8, we're only a few percentage points away from new year-to-date highs and less than 10% away from making all-time highs that we reached back in November 2021. And just staying on the same weekly time frame, just switching over to the S&P 500 equal weight, you can see that stark difference in the outperformance of the mega cap 8, and even more so looking at the most diversified index of the bunch, the Russell 2000, which is much more representative of the US stock market as a whole. You could almost think of this like an equal weight index of 2,000 companies. And one could argue it's still in a bear market like it has been for the last 2 years. And so that outperformance and distinct pattern and concentration is one of the biggest dynamics I've seen in my 20 years of trading. And there's a lot of data out there to back it up as well. And so I have to see next year, is it going to be a case of the rest of the market catching up to these big guys, or the big guys falling back down along with the rest of the market? I guess we'll just have to wait and see. But the stock market's getting excited and trading up, and so is the bond market. Once again, the two markets staying a bit more correlated than usual, as they're both convinced that the Fed is done, and that's a good thing. And we can rally for now without having to worry about a recession. That's why we're seeing big inflows to bond funds like TLT, receiving net new flows of $20 billion this year, despite it being one of the most worst performing major assets out there, and even trading like a meme stock lately with all the volatility. And it very well could be the bottom. Just looking at the weekly chart here of TLT, you can see what a huge fall it's had from 180 in early 2020 after the flight to safety during COVID lockdowns. Just a few weeks ago, we got down to 82, falling more than half, and here we are having a lot of volume, which is something typical you see on bottoms. However, you've got to remember that the Fed has less control over longer dated yields opposed to short dated yields, which they have the majority of control over. And so if one thinks that the Fed is going to be cutting next year, a better bet could be in an ETF like SHY. That's 1 to 3 year treasury bonds, which are generally much less volatile and should respond better in risk reward if the Fed does cut rates next year. And the market's pricing about 100 basis points of cuts next year. And just looking at the weekly chart on SHY, this does look to be like a broad basing bottoming pattern. Triple bottom, whatever you want to call it, looks like it has found support, and we are perking up a bit here. And that offers an almost 3% dividend yield as well, paid monthly. And so this could deserve a spot in a well-diversified portfolio and help hedge typical long stock positions against any recession next year. Because while TLT should rally in a recession, because of record US Treasury issuance, long-dated yields may actually stay a bit higher than what we normally get during a recession after the initial shock and flight to safety. And we've even got Wharton professor Jeremy Siegel saying we're all clear on inflation now, and that the US could risk a recession if the Fed doesn't dial back interest rates soon. He said central bankers should begin cutting rates in March. But according to Cleveland Fed President Loretta Mester, she says markets focused on interest rate cuts is premature, and that lowering the Fed's benchmark rate is not part of the conversation right now. She went on to say it's really not about how long do we stay in a restrictive stance and perhaps have to go higher given what happens in the economy. So the Fed's still trying to talk tough and have been keeping the door open to further interest rates. We'll see what they say on the 14th of December. The market's really banking on Powell coming out and saying something like the Fed feels confident that they're in a restrictive stance and no further hikes are needed, and kind of close the door on any possible hikes. Because looking at the price action in stocks and Fed fund futures, that appears to be front-running that kind of language. And like I've been saying, to get clues on inflation, which is the biggest driver of interest rates, look at one of the biggest drivers of inflation. That's the price of crude oil futures, with a big fall today, down almost 5% on heavy volume, sitting right now at the bottom of this support zone I've got in, just above $73 a barrel. And this is quite the sharp pullback we've seen ever since the surprise Hamas militant attack on Israel on the 7th of October back up here. Oil briefly went up to almost $90 a barrel, then just completely fell over. And that's helped to bring inflation expectations back down, help consumers a bit, but it's also a sign that global economic growth may be a bit weaker than what we've all been thinking, as crude oil is a big input into that. And we saw that on data yesterday, with oil and gas inventories jumping a lot higher than expected. And there's still worries out there about China demand and the Eurozone pretty much flat growth as well. And this is at a time when US oil production is still around record levels, 13.2 million barrels a day, along with other non-OPEC countries producing at record levels to counteract the OPEC production cuts, as the Saudis and Russians would like the price of crude a bit higher than where it is now. And so in addition to that contraction in industrial production we saw today and weak manufacturing, sectors that are a big consumer of oil, we've now got the oil futures curve back into contango after it had been in backwardation for a while. And that coincided with the rally we saw from mid-year up until September. And that's when the front month contract is higher than the second month contract. That's typically a bullish sign for the market. And so right now, crude oil is trading really heavy and is likely to stay in at least a sideways pattern for the foreseeable future. And this has been a big quick change in this market that has knock-on effects to many other markets and the economy itself. Moving on to some earnings today, we got a huge move out of Walmart. Normally a sleepy, low volatile stock, actually fell 8% today. They did actually post a solid quarter, coming in line with expectations of earnings at $1.53 a share. It's a penny in front of what estimates were. But we did hear a bit more of a cautious tone from the CFO and CEO relating to the consumer, and they're seeing some weakness in their consumer and the economy ahead. And just looking at the daily chart of Walmart, I think the market may have just got a little bit of ahead of itself. Had been trading really strong. It was only yesterday that we're at year-to-date highs, and still with a price to earnings of 32. It's a little rich for a huge elephant of a stock like Walmart, but that's just a big move in a big stock in a VIX 14 market, which I thought was interesting. And a big contrast to one of their competitors, Target, yesterday, who finished up over 17% on the back of their earnings. We also had earnings out today from department store retailer Macy's, coming in a lot better than expected, 21 cents a share. Market loved that. Gapped up, it sold off a bit, still finished the day up 5.7%. We also heard from Cisco today, and even though they slightly beat on estimates, they cut their revenue outlook for the year, and the stock market did not like that. Gapping down big today, but doing a bit of a dip buy and hammer, still finishing the day down almost 10%. And the market and analysts may be waking up to Intel stock. If you've been watching my channel, you know I've been talking about Intel for a little while now. I think it's got some tailwinds coming from a spot of good valuation. Been beaten down the last couple of years, makes for good grounds for a catch-up trade to the rest of the chip sector, which has been ripping this year. And so even though they've fallen behind on NVDA, I wouldn't count them out, especially with the US government looking to increase domestic production of chips as a priority and national security issue. And so Mizu upgraded Intel's stock today, saying it could be an under-the-radar AI play, pointing to opportunities related to new server product launches, with their products being very competitive in the data center and enterprise storage server markets, and the potential for them to be a player in the AI field. And once again, the market loved that. Just looking at the daily chart here, up 6.7% on double average daily volume, huge breakout. And just looking at a weekly chart of Intel, since it topped in April 2021 and overlaying that with a semiconductor ETF SMH in the orange line here, I think technically and fundamentally speaking, this could be a good catch-up trade, and we could see Intel rallying into next year and potentially beyond if they keep delivering good quarterly earnings results above estimates like they did last quarter. And finally on news today, just a little bit of interesting story here. Some of you may remember the old fight between Michael Dell, the founder of Dell Computer, and longtime Wall Street raider Carl Icahn. And that was kicked off a decade ago when Icahn tried to stop Dell from taking the PC company he founded private at a $24 billion valuation. Icahn built a stake in it and made a counteroffer, forcing Dell to eventually up his bid. So basically got Michael to cough it up and pay a bit more. Like Carl Icahn normally does, is good at sticking his nose in things and squeezing out a few extra dollars from people. And then 5 years later, Icahn tried to sue Dell in an attempt to stop Dell from going public again, once again forcing Dell to cough it up and pay a bit more for Icahn's benefit. And that's why we saw Michael Dell on X today post this. During the last 10 years, Icahn Enterprises stock was down 80%. The S&P 500 was up 155%. What is the opposite of play nice but win? Referencing the title of his autobiography released 2 years ago. And that must be satisfying for Michael Dell to watch, especially today with Icahn Enterprises stock falling another 11.8%. On the back of going ex-dividend, even though the dividend was only $1, stock price fell 2.3 points and is hovering near lows and has been absolutely smashed ever since that short seller report from Hindenburg Research, bringing a lot of the business practices into question and all the dodgy financial engineering Carl Icahn has done. It's absolutely smoked the stock this year. We were trading as high as $54 a share earlier on in the year. Here we are at a measly $17. And so like they say, what goes around comes around. Just moving on to economic data, there's the initial jobless claims coming in a bit higher than expected. There's that weak than expected industrial production. And we've also got export prices and import prices a lot lower than expected. That weaker import prices could have to do with the stronger dollar, making foreign imports a bit cheaper. However, that's more outweighed by export prices falling 1.1%. So that too could be a little deflationary for the economy. Looking out to tomorrow, we've got retail sales from the United Kingdom, going into some housing data from the States, along with a few more Fed speakers. Fear and greed index right on the verge of going into the greed zone. And corporate insiders staying a little busy here once again. 158 sales yesterday on 103 purchases. And just looking at my institutional buying percentage indicator, that's still slightly in the bearish zone at 43.3%. And the S&P 500 oscillator still in the overbought zone at 60. So both of these indicators are saying we're probably near a short-term top in the market here, coinciding with this resistance level around 4,500, and a few of my other indicators indicating overbought conditions as well, the DSI and these reversal signals. So we could be due a bit of a pullback here, but I'd imagine we're going to find support. We could come back up and test those highs before Christmas, but I expect a period of consolidation going forward. It was another flat day in international stock markets for Thursday, except China, which fell 2%. This market cannot seem to find its footing and put on a good rally. It's just been pretty much weak all year and hasn't managed to string so much as a couple of weeks of rallies together. Japan's Nikkei is one of the best performing markets this year, hovering near highs, and the Aussie 200 is still trading a bit sideways. There's the pickup in oil market volatility, OVX at 42, and a bit more of a quiet day in the options market, 38.5 million contracts traded, still people buying more calls at 53%, and a lot of them expiring in the next 5 days, 60% of all volume. The put call ratio back down to 0.78, so options market's a little optimistic here, but look at the jump and skew, 154. That's the price of out of the money put options on the S&P, and just taking you out to a weekly chart, that'll typically rise before the market rolls over, like we saw in 2021. And then when the market rolls over, like last year, you'll see the skew index, or you could think of it as the price of tail insurance that comes down. Another way to think of it is like a flood. The price of flood insurance increases before the flood, and after the flood's happened, the price of that insurance comes down. So even though we're in a low VIX environment, option dealers are still asking a lot of premium for that tail risk insurance right now. A little bit of a turn down in short-term breadth, and we still have more than half of all stocks underneath their long-term 200-day average. Breadth was a bit soft today, with new lows back to outpacing new highs on the Nasdaq again. The commodities versus stocks are selling off pretty sharply here and oversold, and a continued pullback in inflation expectations. And the risky end of town in the bond market's really not worried. You can see that in the price action of high yield bonds, holding up really good there, still doing a lot better than their treasury counterparts. And the dollar coiling up just above 104, and a bit of pickup in volatility in the crypto market. Bitcoin doing a little bit of a U-turn back down to this new support zone, and we'll see whether that 35,000 level can hold. There's the big fall in the commodity index on the back of crude, but gold once again is doing better, holding up, and looks to be coming back to flirt with these all-time high levels just above $2,000 an ounce. Same deal with uranium, trading up near highs, and the price of your orange juice is about to go up again, trading at all-time highs. Not too far off is sugar, and the price of your chocolate either and cocoa. Over to stock sectors, some more volatility in the cannabis ETF, pulling back here. Same with clean energy, the losing sector today, in addition to energy, oil and gas. Winning sector was actually gold miners, up 1.49%. Coming in second was utility stocks, and third healthcare stocks, and a little bit of a defensive rotation. BlackRock notching up another high, getting pretty overbought there. Same with the mega cap tech, they're really technically stretched here. Microsoft's just almost unbelievable in its persistent strength these last couple of years. Just cannot seem to be held down. And it is remarkable in a 5% interest rate environment to see one of the biggest stocks in the market trade at a price to earnings ratio of 35. And they have been still showing some good growth in their cloud segments, which again is remarkable as well, their actual performance. But the market has more than rewarded them for that, in my opinion. Those buying it here are expecting this PE to keep growing, and that may happen, but for Microsoft to trade at a PE of 40, 45, 50, that would be truly surprising for me. Bit of a pullback in Tesla there. We closed that earnings gap yesterday. This is looking a bit like a reversal formation here. And like a lot of stocks, I expect a bit of sideways consolidating trading, which is a good environment for mean reversion strategies as we don't really have a clear trend. And meme stocks were really weak today, down across the board, and a bit of a U-turn. The last couple of days we saw those high beta stocks, overvalued stocks rip up. Got some sharp turns down there today, and still more volatility in the old economy stocks, General Motors, Walgreens, 3M, and the telecoms doing a lot better than the rest, with the regional banks still bouncing around and the big guys kind of holding their ground. Okay, so my final thoughts on the S&P 500. We're stalling out here like I thought we would. Like I've been saying, I wouldn't be surprised to get a big fat green candle any day or possibly next week to come and test these year-to-date highs around 4,600. However, like all my indicators are showing, I'd say there's probably a 60% chance that we could roll over a little bit, pull back, maybe come back down and touch the 50-day VWAP. By the time we get there, we're probably looking around 43.60, 43.70. We may find support around this area where the market's turned before. And like I said, I expect a period of consolidation for largely the rest of the year, unless we get any big nasty surprises. And that's all I've got for you this Thursday. Thanks very much for tuning in to Click Capital Daily Market Show and sticking with me. I appreciate all your support, and I hope to see you again tomorrow night to finish out the week. Cheers.